This is the Debt Free in 30 Roundtable, where our panel of experts review recent stories in the news about debt and give their take on how these stories will impact you. Let's get started. Here's your host, Doug Hoyes.
This is the second edition of the Debt Free in 30 Roundtable. Unlike our regular shows where I just have one guest, today we've assembled a panel of experts from across Canada so we can cover all of the issues from all of the angles. We're recording this over Google Hangouts, so in addition to the audio podcast on iTunes, you can go to the Hoyes Michaelis YouTube channel and watch the video of the show as well. So let's get started and welcome the panel. Starting out west, Blair Manton is a licensed insolvency trustee. Blair has appeared on the show twice before, way back on show number 8 in 2014, and then show number 60 in 2015, and we skipped 2016 for some reason. So great to have Blair back here in 2017. So Blair, where are you today, and what's the name of your firm?
Sure, Doug. Thanks. My pleasure to be here. So I'm based in Vancouver, and my firm is called Sands and Associates. We've been founded in 1990, and we're the largest firm in BC focused on helping individuals and small businesses solve their financial problems.
Excellent. Well, thanks for being here, Blair. So let's move to the opposite end of the country and welcome Ian Penny, a licensed insolvency trustee who was a guest back on show number 38 in 2015. So it's been almost 2 years since Ian's been on the show. Ian, welcome back. Where are you today, and what's the name of your firm?
Thanks, Doug. I run an independent firm, Janes and Noseworthy. We're the largest insolvency firm in Newfoundland with offices, 6 offices across the province, and I work out of our St. John's office.
Excellent. Thanks very much, Ian, for being here. So we've touched the West Coast and the East Coast. Let's hit the middle of the country with a first-time guest, Daniel Budd, who is a licensed trustee as well. Daniel, welcome to the show. Where are you today, and what's the name of your firm?
Hi, Doug. Pleasure to be here. I'm at M. Diamond and Associates here in Montreal. We're a boutique firm, 3 trustees, but we do a volume game, so it's a pleasure to be here.
Excellent. Well, thank you very much to all of you. We've got 4 stories we want to cover today. That's how we do it on the round table. So let's get started with story number 1. As the panel knows, my firm, Hoyes Michaelis, released our Joe Debtor study a few weeks ago where we profile people who are filing bankruptcy or a consumer proposal. Now, our study only covered Ontario, so I'd like to get your input on whether you're seeing in the rest of Canada what we are seeing here in Ontario. Specifically, one of the most surprising findings for me was the big jump in millennials getting into financial trouble. And millennials, it's kind of hard to define, but basically it would be people kind of under 30 years of age, somewhere in that range, 20 years old, maybe into their early 30s. 2 years ago, only 12% of our clients were under the age of 30. Now it's 14%, and it's growing. Our study found that student loans cause financial troubles for millennials, and often they turn to payday loans. So the biggest problem isn't debt, it's insecure income. They have an average net income per month of just over $2,000, and that's 15% below the income of our average client. And our average client has income that's just over 40% below the median income in Ontario. 85% of them are employed, but obviously a lot of them have low-paying and part-time jobs. So I want to start with the youngest guy on the panel, Daniel Budd. So Daniel, if you don't mind me asking, how old are you?
I'm 30, Doug.
Okay, so you actually qualify as a millennial then. So give me an example of somebody who you have helped who is on the younger age of the age spectrum.
First of all, I'm just going to clarify one thing. I don't consider myself a millennial. I consider myself a 90s kid, but I've been told that's an... So I'll just launch right into it. What we're seeing with millennials, I can give really 2 examples because it's about 50-50. We're seeing, like you've been describing in your study, a lot of millennials who are coming out of school underemployed or unemployed aren't able to see any upward mobility in the fields that they're looking in, not able to pay their student loans as well as their regular unsecured debt that they've accumulated over the course of their studies. And we're also seeing a lot of millennials who are actually just spending above and beyond their means, and who are coming to see us basically with bills that just fresh out of university are their enjoyment, and they're coming to say, you know, I overspent in school, what am I supposed to do now? So those are the two cases we're really seeing. We're obviously trying to help people out to negotiate to settle their debts as best as possible. One big problem for millennials that we see is that student loans, if you haven't been out of school for more than 7 years, aren't dischargeable in a bankruptcy. So if they're coming to us exclusively for student loans, the issue is that they're in a hard sell because they don't really have much relief under the Bankruptcy Act. Now, the student loans department will work with you for the first couple of years out of school, but once you're running on to years 3 and 4, they're really leaving you on your own, and you're really going to be stuck with those payments, which are at that point quite cumbersome and delaying millennials' real entry into productive society.
Absolutely. And what you're referring to is the rule in the Bankruptcy and Insolvency Act that says a student loan is only automatically discharged in a bankruptcy if you have been out of school for 7 years. So it doesn't matter when you got the loan, it's how long have you not been a student for. So obviously someone who graduated from college or university when they're 22 years old, they got a huge amount of student debt, they can't go bankrupt at age 23 and get rid of it. And we can debate whether that's good or bad for society, but we won't have that discussion today. So let me go over to you, Blair, and have you give us your thoughts on, what are you seeing? Are you seeing the same kind of things that Daniel's seeing, or is it different in Vancouver?
Well, I think, Doug, something different that I'm seeing is I'm seeing a lot of folks who have been out of school a number of years, and they're past that 7-year mark. They've been trying, doing their best to try to make good on their student loans, but they're just having difficulty. And especially in Vancouver, what I see here is the income in Vancouver is quite low, and the cost of living is often the highest in the country, definitely from a real estate perspective and a lot of other ancillary costs. So there's income insecurity, and I'm seeing folks where student loans is taking increasingly aggressive collection actions, in terms of freezing bank accounts, in terms of seizing wages. So there's a lady that I worked with very recently who was 30 years old, a single mother, who had $22,000 of student loans, and they were starting to garnish her wages, so she wouldn't be able to support her kids. So we were able to file a consumer proposal, and the good thing is, once it's been 7 years, student loans, from my experience, is very open to considering consumer proposals. We were able to bring her total debts down from about $27,000 down to $9,000. Monthly payment of $150 a month was a lot better than what student loans was asking for, and certainly a lot better than a garnishee would have been. So once you pass that 7 years, there's definitely options, but I've seen an increase in how adamant and how aggressive student loans has become in collecting outstanding balances.
So Ian, let's go to the East Coast then. Are you seeing the same thing with student loans being aggressive? And, question number 2, what are you seeing in general with the younger crowd?
Some of the same things Daniel and Blair have been saying. Sort of the unemployed, underemployed. In my world, that tends to be a single mom, working a minimum wage job kind of things. Just can't make ends meet and pay the student loans. A lot of the male millennials I see have been fortunate in recent years to find high-paying construction jobs, either in Newfoundland, where there's a number of mega projects on the go, and there's also a lot of Newfoundlanders, I think Atlantic Canadians generally, going to Alberta still to work. But what's happened now is sort of a perfect storm. These people are used to making big money. They've overspent. They're driving expensive pickups. Typically, they probably bought a house in Newfoundland at the peak of the market. Housing is now down about 30%. A lot of them have lost their high-paying Alberta jobs, or even their high-paying construction jobs in Newfoundland, now making a third or half of less than they were a year ago, at the same time as their house is now worth a third less than it was 2 years ago. And it's almost like a perfect storm, and there's just nowhere for them to come. So on the one hand, you could say they've overspent. They've probably been over-optimistic, thinking these high-paying jobs would last forever. But now the decisions they've made are coming home to roost. They're underwater on their house. They got a big pickup they can't afford anymore, and their paycheck is not what it used to be. And sometimes student loans mixed in there too. But I think the other problems are the bigger issues for most of the male millennials that I'm dealing with.
So that's interesting. We're all seeing similar, but not exactly the same, depending on where in the country you are. So let's talk practical advice here, because the whole point of this show is to be giving practical advice to people who are watching. So I want to start, let's go west to east on this one. So Blair, let's start with you. What practical advice then would you give to millennials?
Yeah, I'd say, Doug, if there's one piece of advice that, I wish, and I have clients tell this to me, the clients wish they knew this earlier on in their financial career as opposed to learning it later, is this idea of focusing on your financial health instead of your credit rating. I think we're conditioned everywhere these days, focus on your credit rating, get your credit score, monitor it every single month. But what we don't understand is that quite often the activities that you do to improve your credit rating, like incurring debt, like paying interest, like making all the minimum payments, they're often completely the opposite of what you should be doing, which is, trying to put some savings away. If you eventually want to get real estate, you got to save a down payment. But if you're focused on your credit rating alone, you may never get to that point. So I definitely caution people that if you think you need 10 years to build positive credit, you don't. People can go from a bankruptcy to getting good credit, rebuilding credit within just a few years, 2 to 3 years.
Excellent. Well, that's good advice. So, Daniel, what kind of advice do you give people in these situations?
Well, I would say the advice that Blair gave is excellent. It's something that we are telling people on a regular basis at this point. But there's two other points that we are really mentioning to people. One is to really reconcile your needs with your wants. So in order to determine what you're spending, determine actually what you need to spend as opposed to what you want to spend. Spend as well. One of the complaints we're seeing a lot from millennials is lack of upward mobility, especially within the professional class. So what we've been seeing a lot more, we've been suggesting, is to look at different, whereas everybody was just looking for a straight bachelor's degree. In Quebec, there is a huge lack for people who are going for technical degrees, 2-year trade schools. So we're telling people, in order to avoid income insecurity, look at a field where you're going to be able to achieve that revenue that you're looking for, as opposed to one where you're hoping to achieve that revenue you're looking for.
Yeah, and I think that's very good practical advice. Hard to do when you're young to be looking forward, but it's absolutely something you need to do. Ian, last word to you on this question. What kind of practical advice do you typically give out?
Well, I'd actually planned to talk about exactly what Daniel just did, along the lines of, choosing a profession where you're going to find a job, not necessarily something that you just like. And sometimes it's hard to reconcile those two things, and it's hard to predict 3, 5, 10 years down the road where the needs are going to be. But you really need to be careful the field you study in and what your employment prospects are. The other big one I see is that people are very focused on monthly payments or bi-weekly payments or even weekly payments, and they lose sight of the fact that just because a car is $200 a weekly payment, I mean, that's almost $1,000 a month. That's a lot of money for a car payment. They just look at the bi-weekly payment. They're focused on, cash in, cash out every month without really looking at the balance sheet of their life. Am I accumulating wealth? And I think that's the key, is to show year over year, you should be building equity in your assets, building equity in your home, building equity in your vehicles, putting away some money, RSPs, RESPs, all those things. And I think people just look at, is there enough money in my paycheck to make that next payment? And you really need to look a lot farther down the road for long-term financial health.
Totally agree. And you've raised the issue of cars. So that's what I want to talk about, is story number 2. So let's get to that right away. And this is something that impacts millennials, but it also impacts most other Canadians, and that's, car loans. So there was a story in the Financial Post a few weeks ago, and I want to quote directly from it. So Ford Motor Company is seeking to limit the growth in long-term auto loans and leases in Canada, where consumers are twice as apt as U.S. buyers to stretch out payments to as long as 8 years in order to afford a car. In Canada, automakers are selling about 41% of vehicles with loans of at least 6 years or leases of at least 5 years. Demand for long-dated deals are helping drive Canadian passenger car sales, which hit a record for the 3rd straight year in 2016. About 85% of them are bought with debt, according to DeRosier Automotive Consultants. Since vehicles depreciate over time, longer-dated loans significantly increase the chance that an owner ends up owing more than their car is worth, according to a report by the Financial Consumer Agency of Canada. The share of Canadians trading in vehicles with negative equity rose to 30% in 2015, and on average they were underwater by $6,700, according to statistics from J.D. Power. So those are some amazing numbers. I want to start with you on this one, Blair. Give us the definition first of all. What are we talking about when we say somebody is underwater?
Oh, sure, Doug. So that's being underwater is the simple concept of you owe more than what the asset is worth. So, in 2008, when you heard about the real estate crash in the US and people were, throwing the keys back to the bank, that's because they were underwater. They knew if they were going to sell their house, they would never be able to pay off the mortgage. So almost by definition, as soon as you buy a car, unless you put a lot of money down, you drive the car off the lot, it depreciates, 20 to 30% almost instantly. Your financing goes down in a straight line. So for the majority of time when you got a car loan, you're probably underwater, and that's not necessarily a horrible thing. It can be good, bad, or indifferent. But where it can get really terrible is if you start to roll negative equity or you start to consolidate other debts into your car loan. I've seen people owing $60,000 for a Kia Rio, for example, for just a basic car that you would never finance for $60,000. But this might be the second or third time that they've rolled some debts into a car loan. So it really can get out of hand very quickly.
Yeah, once you start rolling, you're pretty much dead. So, Daniel, do you see the same sort of thing in Montreal, or is Montreal everyone takes the bus and no one has a car, and you've never heard of what we're talking about? What do you see there?
No, we're seeing a lot of people coming to see us with negative equity, or as we're saying, underwater on their car loans. I'm not seeing to the same extent, $60,000 on a Kia Rio, but we're seeing people who, in year 4 or 5 of their car loans still haven't built any equity whatsoever. The cars are getting to a point where they're not drivable, that they need to be switched for something else because, as you know, our Montreal winters tend to be pretty rough on cars. And as a result, you're seeing people who are taking negative equity, refinancing it into another car with negative equity, and they're never actually getting out from being underwater on their car loan. They're always in a position where their car is worth significantly less than the amount they have left to pay.
So in both cases, we're seeing people being significantly underwater. Do you see the same thing out east, Ian?
Yeah, for sure. We tend to be a pickup truck and large SUV market out here, and those things are very expensive to buy and very expensive to operate. And for whatever reason, people think they're entitled to a new one every 3 to 4 years. So we're seeing a lot of the rollovers. Same type of thing, buying pickups that are $60,000, $70,000. You're $20,000 short when you trade in the old ones. So now you got a $60,000, $70,000 pickup that, as Blair said, the second you drive off the lot is worth 50, and you got to finance for 90. So right out of the gates, you're 30, 40 grand in the hole, and it's very troubling. Particularly with the high operating costs of these types of vehicles.
So what's the solution then, Ian? How would you advise people who are in that situation?
Well, I was interviewed by CBC a couple of months ago, and I told a little story. I'm one of our senior partners here, and I drive one of the oldest cars on the lot. I drive a 7-year-old vehicle because I own it. It works fine. I own it. And, the next one, if I have to finance it, I'll pay that off and I'll own it for a while too. So I think it's a matter, really, not everybody obviously can put down a down payment or pay it off quickly. But I think if you can't afford to pay off a car in 5 years, you need to go to a cheaper car. And, just because you make that last payment doesn't mean you have to run to the dealership and get a brand new one. Drive it for a year or two. Build up some equity, go in with the next time you got a down payment. It'll be that much easier to pay it off in 5 years. And over time, you can actually build equity in a vehicle, although not many people ever achieve that.
Right. So, Blair, I'll give you the last word on this particular one then. So, again, practical advice. What should someone do who's underwater, and how specifically does it work with a car loan if I do have to go bankrupt or file a consumer proposal?
Yeah, Doug. So if you go into a bankruptcy or file a consumer proposal, a car loan is just one of these other obligations that you have the option of restructuring. So, if you feel that, the right thing for you to do is to continue to be underwater on your vehicle and to continue to make the payments, if you file a bankruptcy or a consumer proposal, the trustee is not going to have an issue with that other than trying to counsel you, are you sure this is the right decision? You'll be allowed to keep that car even though there's negative equity. Now, conversely, if you need a chance to make a break from this type of a contract, a bankruptcy or a consumer proposal can be, the perfect method for you to restructure everything in your life, including your car loan and your obligations, and perhaps get a car that's more in keeping with what you can afford or that doesn't have huge amounts of negative equity. It's really important that you understand the different provincial laws that may apply when you're, either stopping to pay on a car or giving it back or things like that, because in the province of BC, you may not be held accountable for that negative equity, whereas I'm aware in the province of Ontario, you probably would be held accountable for that negative equity outside of a bank or a consumer proposal. So if you stop paying, make sure you understand which province you're in, what the protections are or maybe are not.
Yeah, and I guess the final word on this, unless anyone else wants to jump in, is exactly that. You should get some expert advice on this. In Ontario, you are allowed to keep a car worth up to a certain amount. And if you have a car loan, exactly as Blair said, you can keep the car and keep paying for it. But if the car is worth $10,000 and the loan is $30,000, then does it really make sense to agree to keep paying $30,000 for a car that's worth 10? Maybe you'd be better off to be surrendering the car before you file your bankruptcy or your consumer proposal. That shortfall then becomes one of your debts that gets included in the proposal or bankruptcy, and that's truly giving you a fresh start. So I think that's all good practical advice. And again, this is an area where you've got to get professional advice to decide what to do. Now, there are two big purchases we make in our lives. Cars are one of them. Real estate is the other. So that's story number 3. Let's talk about real estate. And both Blair and Ian have discussed this on past shows, so I'd like to get an update from both of you. Vancouver's been in the news with all the crazy real estate stuff that's been happening there. Has that eased off, Blair? I mean, now we're into April of 2017. I know that there were some new foreign buyers taxes or things that have come into place. Have things changed in Vancouver, or is the real estate market still crazy?
Still crazy is what I would say, Doug. And I think the government's not helping, essentially, because they're putting measures essentially on two sides. They're trying to calm the market by putting in foreign buyer taxes and putting in, empty house occupancy taxes. So if you're speculating you're buying a house, if it's not occupied, you'll pay a tax on that every year. But on the other side, they've now instituted a down payment matching program. So if you're a young individual or couple and it's your first time home buyer, the government will match your down payment up to, I believe it's about $50,000 or so. Interest-free for the first 5 years, no payments. And what they're doing is throwing gas onto the market once again and putting every taxpayer, investing into it. What I've seen is it's kind of a lull in these days. The market seems to be holding in terms of values, but a lot of people are really having trouble because, if they've got a bunch of debts and notionally they've got a lot of equity in their house, they're really having trouble accessing that equity. And I'm seeing a lot of second mortgages that are just ridiculous fees to arrange and high rates. So I think folks, notionally it's great that your houses went up so much, but if you can't access that equity, it can really constrain. And I think a lot of folks are going to face a difficult decision of perhaps having to sell to pay off some debts and not being able to purchase anything close to what they had before.
Yeah, and it's crazy that the government on the one hand keeps interest rates low, and then they in Vancouver and BC, as you say, have put in these things to help you buy a house, but then on the other hand, they put in taxes to discourage it. I almost wonder if maybe it would be better if they just stayed out of it. But we won't get into that discussion here today either. Ian, you're in a province that, as you already described, is impacted by the price of oil, which is lower today than it was a year, 2, 3 ago. Is that impacting the real estate market in Newfoundland, or are you seeing anything different than what we're seeing in places like Vancouver, for example?
Well, we've sort of been through the boom, and now we're arguably getting into the bust. So in the last 15 years, we've gone from a very stable, relatively low-priced real estate market to one since about 2002, 2003 that houses roughly tripled in value in about 15 years. The last year, they've probably gone down about a third. So they're probably somewhere in the middle of where they started and where they were at the high water mark. Again, what we saw during the boom years, which ended about a year and a half or 2 years ago, was a lot of people refinancing houses, speculating on houses. There's a lot of very expensive houses now that are for sale that there doesn't seem to be a market for anymore. A lot of people that refinanced or, put 5% down kind of thing when they bought, are finding they're underwater on their house, maybe lost a job or a reduction in income, really, really struggling to make that mortgage payment now. And little or no market for the house at anything approaching what they're into it for. So a very, very challenging time now for real estate in Newfoundland for sure.
Wow, and that's the problem with owning a house, obviously. They go up and they go down. So I'll talk about what's happening in Ontario, but first of all, what's happening in Montreal specifically, and I guess Quebec more generally. I'm assuming, Daniel, you're a bit insulated from the whole oil boom and bust that we've seen in other provinces. What's been happening in Montreal?
The truth is Montreal and Quebec have had a relatively, and I say relatively, stable housing market because it's had modest increases, as everybody's seeing. There's been no exponential boom or bust. But we are seeing that the island of Montreal and I'm not as aware of what's happening with Quebec City, the other major metropolitan area, but on the island of Montreal, you've had modest growth. Certain areas, you've had a little bit higher growth. The condo market has been booming, but a lot of people are very skeptical because a lot of it is like we see in Vancouver, foreign investment. It's coming in. There are a lot of empty units, a lot of large corporations who are buying up units to be able to rent out on a daily, monthly, weekly basis to workers who are coming in for specified periods. But we haven't seen too many people who are experiencing massive growth in the value of their houses. It is because the economy in Quebec has been relatively stagnant for the past few years. What we have seen is that first-time home ownership has reduced. You are also talking to a first-time homeowner in the last year, so maybe I have a bit of a skewed perspective myself. But what we are seeing is less younger individuals looking to purchase homes. Whether that's going to have an impact on the market in the short and medium term, we'll have yet to see. But for now, all I can say is it's been pretty stable. Outside the island of Montreal, we have seen some decreases depending on specific areas. Areas that are more depressed economically are obviously having worse times, but by and by, relatively stable.
So that's interesting. We've got, boom and bust on the east and west coast, and Montreal has been a little bit more stable. I can tell you what's happening here in Ontario. And again, as we record this in the middle of April 2017, the real estate market is still absolutely crazy. House prices in Toronto and all the outlying areas are still going up substantially. And as a result, in our Joe Detter study, we found that homeowners are now a lot less likely to be filing insolvency. Back in 2013, almost 30% of our clients were homeowners. By 2015, it had dropped to 24%. And in our latest study, it's down to 17%. And it's pretty easy to see why. If your house has gone up in value, you can refinance and use the money to pay off your debts. But here's the problem. Refinancing your house buys time, but it doesn't buy security. So it's not dealing with your underlying debt problem. And in fact, of our clients that are homeowners, their average unsecured debt, so this is not your mortgage, not your car loan, your unsecured debt was over $72,500, which is much higher than the average of $54,000 that our typical insolvent client sees. So it's obviously a pretty serious problem. So okay, let's talk practical advice here, and maybe I'll start with you, Daniel, because like you said, you're the new homeowner. What are you telling people either when they're thinking about buying a home or when they've bought a home and perhaps they don't have the equity that they were hoping for?
It really depends on the specific situation, as always. For people who are looking to buy a home, what we're telling them is make sure your ratios work. One issue that I've been promoting quite a bit here in Montreal is financial education at a young age and teaching people what proper ratios are to be able to spend on your housing versus your transportation versus your food versus your savings. So what I tend to tell people is really do your math, crunch your numbers, make sure you can afford this house. And don't forget, if you're not putting down 20%, CMHC insurance that you're going to have to pay into your calculations, because most people don't remember if you're not putting down 20%, you're getting the added insurance on top, and your mortgage payment isn't necessarily going to be what you're planning for it to be. As a first-time homeowner, my advice is it's going to cost you much more than you ever possibly expected. So really be ready for everything to come out of the woodwork, to have additional expenses that come out of nowhere. And don't forget about property taxes, condo association fees, school taxes, because again, these are part of your housing cost and should be taken into account in those same ratios.
Makes perfect sense. So are you seeing the same thing, Ian? And would you have the same kind of advice to people, or are you seeing anything different? Like, again, let's keep it to practical advice here. What are you telling people they should be focusing on?
Well, I often see people that are underwater on their house, and in that circumstance, you sort of suck it up and you say, yeah, I'm going to get rid of my unsecured debt, but I want to have the house. I'm not going to be able to qualify for another mortgage in the short term, so I'm going to accept that I'm paying more for a house than it's worth. Some people I see do have equity, and refinancing is definitely an option for some people to get out of trouble. But what I always drive home then is you got to change your behavior. So it's no good to get 50 or 100 grand out of your house, pay off all your debts, and then go right back to spending $2,000 more a month than you're earning. So that's the key there, is to change the behavior that caused you to incur all that unsecured debt if you are going to take the equity out of your house, take the hit to your balance sheet, remove, the most of the value in the major asset you own, make sure you change your behavior so that you can protect it going forward.
Yeah, because whatever caused the problem probably won't be the solution to the problem. So, final word on real estate to Blair. Again, you kind of painted the picture for us what it's been like in Vancouver. What practical advice do you give people who are worried about their housing situation?
Yeah, I would say, and it's a very common thread here is, make sure you understand what the options are and you get the right expertise at the right moment. If you've got a bunch of equity in your house and, the bank won't let you take it out because of whatever reason, their risk is high or things like that. There's a bunch of alternative lenders that are out there, and you really have to go in with your eyes wide open. I've seen clients come in and show me some term sheets from alternative lenders where, they'll access $150,000 of equity from their house, but the upfront fees are about $15,000. So it seems a very high origination fee to me. And then the rates that they're looking at are sometimes, in the mid double digits, and we're in a historically low interest rate environment. So if you're only able to get money out at very high origination fees and at very high rates, you really need to look at the bigger picture and say, is this something I should be doing? Or is the right time now to really, as Ian said, change the behavior, to restructure things and to look at, can I stay in this house? And if so, what changes do I have to make?
Yeah, and they're tough decisions because, of course, it's a home as well as a house. It's something that we feel very emotionally attached to. So trying to separate the emotion from the actual numbers is not easy. But, I see exactly what you're seeing, Blair, where people refinance, they get a second mortgage, and the interest rate is massive. So you kind of wonder if that was really a good decision. But, well, that's some good advice on that. So let's go right to story number 4, which I think will be of interest to everybody listening. On April the 5th, the Financial Consumer Agency of Canada, FCAC, which is a division of the federal government, issued a press release with the title Consumer Alert. They probably didn't say it in the same terms, but Consumer Alert. Be cautious when seeking help to pay off debt or repair your credit. Let me read from the first couple of paragraphs of this press release. FCAC is warning consumers who can no longer keep up with their debt payments to be cautious. Some companies are misleading consumers by promising quick and easy solutions to help pay off their debt or repair their credit. In some cases, consumers may end up in a worse financial situation than before they got help. It's important to understand that these companies, number 1, cannot guarantee they will solve your debt problems. Number 2, cannot quickly and easily fix your credit score. And number 3, should not encourage you to take out a high interest loan as a temporary solution until other repayment options are in place. They're probably referring to payday loans there. So let's go east to west on this one. So Ian, what are you seeing out east? Are you seeing companies that promise these solutions but are often not able to deliver?
Yeah, I don't think they're quite as pervasive as maybe in some of the larger centers across Canada, but we definitely are seeing it. We see debt counselors, we see credit counselors, credit repair people. I think the simple message here is, but really buyer beware. You need to ask questions. If you've got damaged credit, if you're overextended in terms of the amount of debt you're carrying, there's no simple fix. You cannot fix this overnight. It's going to take work. It's going to take time. And if you're going to pay somebody to help you, you really need to ask questions. Make sure you do your research, talk to multiple people, understand the service you're getting for the fee you're paying, because a lot of the services that you pay for are actually available for free from people like ourselves, licensed insolvency trustees. I think it's important to remember that the only debt advisors that can reduce debt, compromise debt, are licensed insolvency trustees, and we can do it through proposals and bankruptcies. We're the only ones that can do proposals and bankruptcies. Anyone else may be able to get interest reduced or forgiven, but they cannot compromise their debt without a licensed insolvency trustee. And some of them, their model is to charge you a fee and then just introduce you to a trustee. It's something you can do yourself. So I think the message would be from me, do your homework for sure, talk to other people, but make sure a licensed insolvency trustee is on the list of people you speak to before you pay any money or make any decision.
Excellent, because as you said, you're not going to be paying an upfront fee when you come and talk to one of us. So Daniel, I recall, and you're going to have to fill in the blanks for me here, that in the past, Montreal and Quebec in general had some issues with these kind of people, but they kind of have been managed to clip their wings. What's going on in Quebec with respect to these shady practitioners who pretend that they're able to help you but really can't?
The truth is they had really blitzed the airwaves, TV, radio, lots of print advertising more than 3, 4, 5 years ago. At which point, and I believe it was the Bureau de Protection des Consommateurs, so the Consumer Protection Office here in Quebec, had actually issued press releases advising people to stay away from these types of companies. Their method of operations, which was essentially take in payments for 3 months, let the individuals go into default, and then hope for a good solution, really became aware in the province of Quebec. Now, we do have generally higher than average per capita insolvency rates compared to the rest of the country, for whatever reason that might be. So we really saw a prevalence of these types of individuals with the 2008 financial crisis. They were really quite busy for the next few years, but people really saw them for what they were. And we tend to see less and less people coming to see us now, coming from these types of agencies, whether they be credit counselors or they call themselves consolidation houses. And a lot of the times, at the end of the day, what ends up happening is like Ian was saying, they do just end up getting referred to trustees, although the debtors end up having to pay a fee unbeknownst to them to the licensed insolvency trustee at the end of the day. So yes, it was a problem. Yes, it still continues to be a problem, but not to the extent that we were seeing 3, 4 years ago. It seems as though the population has woken up to a certain extent and understands that these services, like we've said, are available for free from a licensed insolvency trustee, and they're regulated when it's with a licensed insolvency trustee, and that's what people want to see, is the regulation.
Yeah, I totally agree with that. So Blair, last word to you. I know that there's been a whole bunch of these companies operating in British Columbia as well. Are they still out there now? And what kind of advice are you giving people to stay out of trouble with them?
Yeah, so definitely there's still some presence in the market here. It's better than it was in past years. In past years, there were a lot of U.S.-based companies whose model was outlawed in the U.S., so they started to set up outbound calling. Everything you would do is over the phone, but they were clearly not local folks. Here there's still a large presence of local businesses who still focus on, credit repair and debt relief. And for some clients, they provide a service, but for the vast majority of clients, it's nothing they couldn't do themselves or couldn't get for free from a licensed insolvency trustee, as we've said. So, the old adage of if it seems too good to be true, it likely is. There's no easy way to reduce your debts and keep your credit rating pristine. As I mentioned earlier, it's the magic trick of misdirection to get everyone focusing on their credit rating at the expense of your financial health. Often you need to compromise one to fix the other, and the right decision is to take a hit on the credit in the short term for your long-term financial health.
Yeah, I totally agree. And I think that's a great way to end it, that we get focused on, I've got to have a really high credit score, but wait a minute, you owe $50,000 or $60,000 on credit cards, payday loans, you're getting killed on interest. That's the bigger priority. Let's get your debt cleaned up and then worry about all the other things. So I think that's fantastic advice. I want to thank everybody for being with me here today. We're going to close the show by, I'm going to go around the table, and I'd like each of you just to tell us how people can find you. So maybe give us your website address, the name of your company again, and then what I will do is put in the show notes links to all this stuff. But let's do it west to east again. So Blair, how can people find you?
Sure. So we're Sands and Associates. Online, you can find us at www.sands-trustee.com. And we operate out of 15 offices stretching across the Lower Mainland, Vancouver Island, and the interior of BC.
Excellent. Well, thanks for being here, Blair. Daniel, what about you? How can people track you down?
Well, we're one centrally located office in Montreal. You can always go to our website, www.mdiamond.ca, or you can give us a call, 514-483-2303. We're always available to answer. I myself love to forward my phone to my cell phone, so you'll always be able to get a hold of me to your benefit. But again, thanks for having me. It's been a pleasure.
Excellent. Thanks very much, Daniel. And Ian, how can people track you down?
We've got 6 offices all across the island portion of Newfoundland and Labrador. You can get me on www.janesnosley.ca, and we actually launched a new landing site just a few months ago, nodebtnl.ca, where you can do a checkup on your financial health, and lots of great links and insights in there. And we're here when and if you need us.
Fantastic. Well, again, thanks very much for being here, guys. And I will have full show notes in the show notes over at hoyes.com. That's HOYES.com. and links to everybody who was here today. So pretty much wherever you are in the country, we can help you. And I think the key message is we know people are dealing with a lot of debt, but there is help out there. You don't have to worry if you're way underwater on your house or your car, as we talked about. There are solutions to that. But debt problems don't go away on their own. There is no quick, easy fix where you can just pay some guy a few bucks and everything's perfect. But there are solutions that are actual real solutions regulated by the federal government, consumer proposals and bankruptcy being two of the most obvious ones. And again, only a licensed trustee can help you with that. So full show notes explain all of that. That's our show for today. Thanks for watching. Until next week, I'm Doug Hoyes. That was Debt Free in 30.